Welcome to the second part of Chapter 12's PowerPoints. So we're now moving to the asset side of the balance sheet. The first item is cash. It's vault cash, or what's in the accounts at the Fed that the bank has. Obviously this is reserves as well, and banks also do actually hold cash. They don't necessarily keep everything with the Federal Reserve because they need vault cash in case people come into the banks wanting to cash checks and want the cash. Of course, cash doesn't pay the bank anything, so usually banks try to manage that so that they have what they need, but no more than what they need, because cash doesn't pay you any interest. So holding cash as an asset is a must for a bank, but on the other hand, you don't want to hold a whole bunch of excess reserves if you can help it. You'd prefer to hold, obviously, loans or something that gives you a return. Or securities for that matter, and that's what we turn to next. Securities. US commercial banks are allowed to hold securities that are issued by the US government or US government agencies, and that's it. So not allowed to hold corporate bonds, for example. So basically, US treasuries and US government agencies issue bonds, and the banks can hold those. And these financial instruments trade in very deep markets. That means they're highly liquid, so it's very easy to get rid of or sell, I should say, one of these government agency bonds or government bonds because there's a very big market for them. So it's not a problem. It's very liquid. Also, the government bonds are very safe, and because they're backed by the US government, so the chances of them ever defaulting are virtually zero. The downside, though, is that these financial instruments, as you know, don't pay very high interest. So although they are safe, they're a bit boring, and they don't pay the kind of interest that you can get on loans, for example. So let's move to loans as we're talking about those. Basically, banks give all sorts of different types of loans, and here's a list of them. So self-liquidating inventory loans. So these are loans for companies to buy inventory, and then once they start selling the product and the money starts flowing into their bank account, and those inventory loans are automatically deleted once the funds arrive in the account to delete them. The seasonal borrowing. So there are various industries that work on a seasonal basis. So in other words, in the off season, you have to borrow. Usually you end up borrowing because that's not when you do most of your business. Interim construction loans. So these are loans to build a property before the property can be sold. Security dealer financing. So these are securities dealers. So they actually deal in the bonds. And they have often, well, not often, nearly always, they have some kind of arrangement with a commercial bank, or they're part of a commercial bank that gives them an account where they can borrow money. Retail and equipment financing. So this is for corporations that are in the retail industry or require equipment and it needs financing, and the banks will certainly cooperate and be part of loans for those particular industries. Longer term loans, there's a whole list here, as you can see. There's term asset based, so these are fixed asset or blind spot. They're called blind spot loans. So they're for a certain term, and they're to usually purchase assets, so basically invest for companies. Project loans, so more than one bank participates or lends a portion of the total loan. So these are usually for construction projects and things like that. They're created for financing large long-term projects. And usually there's a syndicate of banks, so there's not just one, there'll be several banks go in, often with a lead bank. The lead bank does all the negotiations, and then the other syndicate banks come along and they just supply some of the financing. And that way, on these very large projects, you can kind of diversify the risk. So between several different banks, just in case the project goes wrong. Leverage buyouts, these are investor or private equity funds, and they borrow funds to buy all of the outstanding shares of a corporation. So these long-term loans, a corporation will approach the bank and say, we need a leverage, we're going to do a leverage buyout. Can we borrow money from you in order to do that buyout of the entire company? Once they've got the control of the entire company, of course, the company then becomes privately held, during which it can be improved, and the shares can then be sold at a higher price, and then the loan can be paid back to the bank. Repayment of the loan occurs when the shares are sold, yes, obviously. Agricultural loans, these are subsidized by the federal government. So these are special types of loans usually, and they are for either industrial kind of agricultural companies. They can be for medium-sized farms as well, and they include loans for things like equipment, feed, seed, and even things such as water. Short-term consumer loans now. So what we've done there is we've dealt with corporate loans, but here we look at the consumer area. First of all, credit cards. Credit cards are loans. So borrowers, basically spend on credit, and these are unsecured. So in the sense that there's no collateral placed with the bank to secure the loan. With an auto loan, for instance, there would be the car itself would be the collateral, but with a credit card, there isn't anything there. So that's why one of the reasons why credit card interest rates, by the way, are so high. Unsecured personal loans, these are sometimes called signature loans. The borrower offers no collateral either, only their signature to get the loan. Oftentimes banks will do this as long as you have other assets, and if you look at the paperwork, it'll say that you have to sell the other assets if you lose your job or in bad circumstances or a bad situation. So they want to make sure they get paid back. So there are usually clauses in the loan which make sure the bank doesn't end up out of pocket. Unsecured personal lines of credit, these are similar to a credit card. There's a maximum amount the borrower may borrow, but they don't typically borrow the entire amount at once. Often, if you have large amounts coming in and out of your account, and sometimes it takes time for things to clear, so checks to clear, and a check come in, but then you have to write another check to pay your rent or something, then the bank often will say, oh, why don't you just get a personal line of credit? I have one of those, and not cheap. I think you pay about 14% on an annual basis, but it's better than the check bouncing. Just the fee for the check bouncing would exceed the interest for a couple of days. So a line of credit often just means you can go into overdraft. Basically, the loan then basically immediately starts as soon as you go into overdraft, clears your account, makes sure you're back to zero, and then when you have the check clear or the money come in, then the loan gets deleted again. So those are personal lines of credit. Of course, there's long-term consumer loans, and the most common of these is obviously the mortgage. So these are first mortgages. They're used by the borrower to obtain funds to purchase real estate. Usually it's 15 or 30-year terms, and you can have fixed or adjustable interest rates. All sorts of different mortgages. Home mortgages, the second mortgage and equity lines of credit. The difference between the market value of the asset, a house, and the amount owned on the asset is called equity. So for instance, if I have a mortgage for $150,000, but my home is worth $300,000, then I have $150,000 of of equity in the property. So in other words, have a kind of a net value, if you like, for the home of 150,000, and I can often borrow against that. So that's an equity line of credit, or I can get a second mortgage, another mortgage, if I wanted to. So those are called second mortgages. Auto loans, I think we've talked about already. So by the way, on the mortgages, of course, the home, in other words, the property is the collateral. On auto loans, obviously the car is the collateral. Then there's other vehicle loans and other types of loans as well. So motorcycle loans, boat loans, musical instrument loans if you happen to be a musician, etc., etc. And here's a list of assets. So this is for JP Morgan Chase. So we've got the total cash and due from banks, so that's reserves basically. Then what they call investments, which is the holdings of securities. You can see them there. Fed funds sold, so this is basically lending to other banks through the Fed funds market. So you can see that there. And treasury securities, state and municipal bonds, mortgage-backed securities. So banks are allowed to hold mortgage-backed securities, by the way. Other types of securities, they'll probably be state agency securities, so Amtrak or post office or something else. Other investments, I'm not sure quite what those are, but they're quite sizable for JP Morgan. And you can see their investment growth there as well. Moving down to net loans, I didn't have enough room for all of the lines in the balance sheet, but let's just take the first two, commercial and industrial loans. You can see it's quite a large amount for JP Morgan. The consumer and installment loans are a lot smaller. So let's give you an example of those assets. Below that, there's the physical assets as well, of course. The other thing that banks own is property, often the offices where their branches are located. Quite often they'll own that property. Banks can hold property, and that goes into the balance sheet as well, the value of the property. Now, there are what's called off-balance sheet activities for banks. And, as I said, the balance sheet shows you how the bank basically earns its money, and it's through lending and taking in deposits. But anything else that gives the bank an income, apart from the purchase of assets, so the interest on those assets, like government bonds or state government bonds or government agency bonds. Anything else in terms of income, so fees, for instance, charged to consumers, that is so-called off-balance sheet activity. So bank fees have been replacing the shrinking interest rate spread. So the spread is the difference between what the bank can charge to loan out, so in other words, on its assets, versus what it has to pay on its deposits and savings accounts. So that difference has been shrinking in recent years. So the banks have been looking for other ways to replace their income, and one of the ways is to charge fees. Another way is to do other types of transactions as well, and those are called off-balance sheet activities. Another area that the bank works in is commercial letters of credit. So a letter that the bank produces explaining if a buyer does not pay a seller for a good or service, the bank will pay instead. So it's kind of a guarantee in doing business that the bank can write a letter saying that, for instance, for an exporter or an importer, I should say, the importer, of course, is importing the goods, and the goods are going to earn the company some income, but the goods have to be ordered first and have to be shipped and all the rest of it. So the bank will write a letter of credit saying if the buyer of these imports doesn't pay, then the bank will pay instead. So if the buyer and seller agree upon payment, and the loan was not made, there's nothing to put on the bank's balance sheet, but the bank charges a service for that. So a bank does not extend the service to the buyer for free, it charges. Standby letters of credit. This is where a bank promises to pay a third party if the bank's customer doesn't repay as promised. It's a much more general commitment than a commercial letter of credit. It's not tied to a specific transaction, like with my import or export example. So banks view standby letters as a risk-free way to, once again, generate some fee income. Lastly, financial derivatives. So these are basically an agreement between a bank to exchange currencies or interest payments at an agreed upon price at some date in the future. That would be a future, or the right to do so. That's an option. So these are what we call derivatives. They're like bets. There are more complex types of derivatives called credit default swap contracts. That's where the bank that issues the credit default swap is ensuring repayment to the issuer of the financial contract. So here you can have kind of insurance on payments as well, and that's called a credit default. So if you're not going to make payment, then you default, credit default. But the swap contract means you can swap it for something else. So that's what that all means. It's kind of like an insurance policy, basically. And that's the end of the chapter. Thank you very much for listening.